Are the bears stalking the market really just pandas? This week may have started out as a crisis made in China before a heroic stock market rally which started last night. But it ripped through equities and currencies so badly because prices started out high, a lot of borrowed money was being used and investors weren't prepared for bad news. The worst case scenario is still very much centred on China. A hard landing or a rapid devaluation or both, pushing China to liquidate trillions of dollars held abroad, eviscerating demand for commodities and so ripping through emerging markets and sending damaging deflation and even recession across to the West. Now, on this view, Wednesday's US market recovery and the follow through in Asia and Europe today are no more than a dead cat bounce. The best case scenario, though, says that China fears were merely the trigger for a much needed correction. As with the panics of 2010, 2011 and 2012, this is just a temporary setback in a big bull run. Now, for the moment, this doesn't look much like a bear market, but rather an ordinary correction exacerbated by the high degree of complacency beforehand. There were plenty of signs that the equity market was running on fumes. Valuations, here the popular price to forward earnings ratio, had risen much faster than profits or sales in both the US and Europe. So investors were putting more faith in unseen earnings far out in the future. Since last year's results season, there's been little evidence of improvement, with revenues and reported profits falling. At the same time, Wall Street analysts have marked down their expected profits over the next year in the US. You can see that in the blue line here, going pretty much nowhere since late last year. Although I should say that Eurozone and Japanese profit expectations, that's the red line, the Eurozone just ticking up a bit, and the yellow gold line here for Japan going up really quite a lot as the yen was falling fast. Against that, of course, emerging market profit forecasts have been tumbling for 4 years, that's shown in green, and had accelerated recently as well. Meanwhile, the US market itself had been on hold in an incredibly tight trading range as the bull market lost momentum. Defensive stocks had outperformed as investors played it safe, but money had stayed in equities, in part thanks to the rather poor returns available on alternatives like bonds and cash. David Bowers and Ian Harnett of Absolute Strategy Research in London had also been warning that slower global growth and weak capex and world trade were being ignored by investors. That meant that a correction was just a matter of time. If China was merely the trigger for this correction in a complacent market, the share price bounce that followed the plunge may be more than just the usual reversal of a heavily oversold market in the short run. There are genuine problems worth worrying about, though, all the same. Emerging markets and commodities are struggling with outflows of fast money. China's troubles may be way worse than anyone thinks. The data is so flaky that it's hard to tell. Fear about possible Federal Reserve tightening could reawaken as well. On top of that, the petrodollar-fueled sovereign wealth funds and the emerging market reserve managers who've been steady buyers of bonds and equities for 5 years are shifting to become sellers. That could exacerbate downward pressure on valuations. Even so, there's now more of a buffer. The S&P 500 fell on Tuesday to less than 15 times the estimate for earnings over the next 12 months. That's the blue line at the top here, before the bounce that started on Wednesday. Now that compared to more than 17 times back in March there. And since the mid-1980s, valuations of PEs at this level have been consistent with what looked like perfectly reasonable returns over 10 years of about 5 to 6% a year above inflation. That compares to an expected return of just 3% above inflation in March. Now, longer-term data does show a very wide margin of errors needed to be put around these guesstimates of longer-term returns. And if we go back even further, using Robert Shiller's cyclically adjusted measure, it looks like shares are still very expensive at 24 times earnings over a decade, against an average since the 19th century of 17 times. That's a very big gap. Now, investors, of course, can do little more than guess what China and the rest of the dollar zone are going to do and what the effects of their actions will be on the US and Europe. But what we can say for sure is that shares are a lot cheaper than they were, that commodity prices are much closer to their 2009 lows, and bonds still offer very little in the way of income. With all this facing them, investors need a pretty strong belief in the bear story in order to hold on to a lot of bonds or cash at this point.